This is a recording of an overview of Chapter 7 slides. Chapter 7, we are talking about itemized deductions. So we talked about above the line deductions in the previous chapter. Now we're talking about below the line deductions reported on a Schedule A. This includes medical expenses, taxes, insurance, charitable contributions, casualty losses, and miscellaneous deductions, which were suspended through 2025 with the Tax Cuts and Jobs Act. So I'm just going to, before we move on, drop a Schedule A here so that you understand. There's also a copy in Moodle. The 2024 forms have not been released, but this kind of shows you how you would talk about this. So medical and dental expenses, and then we would enter the AGI, and we would need to multiply that by 7.5%. So medical needs to be more than 7.5% to make it onto the Schedule A, 7.5% of your AGI. SALT, state and local tax, which is right here, which we will talk about, has a maximum deduction of $5,000 for an individual and $10,000 for married filing joint. We'll talk about interest you paid, gifts to charities, casualty loss, and other items. So that gives you an idea. Itemize you would take if it exceeded the standard deduction. So let's talk about what is medical expenses. So expenditures for the diagnosis, cure, treatment, or prevention of disease affecting any structure or function of the body. So what is deductible? Prescription drugs. Any expenses related to the diagnosis, cure, and treatment, labs, doctor visits, MRIs, etc. Your health insurance premiums if they are not taken out pre-tax through your employer. Your capital expenditures, this means if you need to put in a ramp for a wheelchair or some sort of special thing. Nursing home and special schools, travel and lodging. What is not deductible? Elective cosmetic surgery. Any marijuana, because it's federally illegal even if it's a prescription. Dance lessons, health club dues, the gym, any over-the-counter drugs, any vitamins, right? Cosmetic surgery for unnecessary cosmetic surgery is not deductible, but if you had surgery because of a disfigurement and an accident or an injury or something like that, and it's still considered cosmetic, if it was required, then it would be deductible, right? Nursing services need not be performed by a nurse as long as the services are related to that. In general, regardless of a taxpayer's method of accounting, medical expenses are only deductible in the year that they're paid. So if you're on a payment plan, you can only deduct what you've paid. The exception would be under a provision of medical expenses of a descendant may be deducted in their final year. An example of that, Daniel, a calendar year taxpayer, died on March 10th, 2021. At the time of his death, the medical expenses owed were $4,200, one in 1 year and one in the following year. If these expenses are paid by Daniel's estate or surviving spouse within 1 year of the death, they can all be claimed on the 2021 taxes. So, what is the medical expense deduction? Whatever you paid in the year for medical expenses, and you cannot deduct anything that you put through your HSA because that is also pre-tax money. And then your total expenses on medical expenses needs to exceed 7.5%. So let's just say Viola has $10,000 in medical expenses. Her AGI is $10,000, sorry, and her medical expenses are $1,250. So we take the $1,250 and we minus 10,000 times 7.5% or $750. So therefore $500 would end up on the Schedule A. Then we need to further see if Viola itemizes to see if she's really taking anything for that medical. So capital medical expenses include wheelchair, medical bags, seeing eye dogs. It must be medically necessary, advised by a physician, used primarily by the patient, and reasonable. I always go to the Big E and I see people talking about, well, this hot tub is a medical expense. Well, could it be? Yes. It could be recommended that it would be good for you from your doctor, but unless you get a prescription for a hot tub, it's not deductible. Okay? Capital improvements to the home is deductible in the extent that the cost of the improvement exceeds the increase in the home value. The exception would be removal of barriers for a handicap home deemed to add no value. So if you have to remove a wall or something so that the wheelchair could fit in, that's deemed to have no value, even though technically it could have value. Improvements for accessibility are always deductible. Handicap ramps, exit and entrance, modifications to the bathroom and kitchen so someone who is handicapped can use it, that is always deductible. Certain qualifying home things to renovate. So the IRS has allowed medical expenses for modifications to vans, automobiles, and telephones owned by handicapped taxpayers as well. If the primary purpose of the nursing home or the special school is medical treatment, then all costs, meals and lodging, qualify. If the primary purpose is personal and only a specific amount of medical costs qualify, then you don't get to deduct meals or lodging. So I had a client that needed to go to Boston for a significant amount of medical appointments, etc. So the transportation to and from the medical care is deductible at 21 cents per mile for 2024. You must keep a log. Lodging while you're away from home for medical care is allowable and a $50 per night per person amount. Jason lives in New York City and had a circulatory condition that resulted in several strokes. His physician advised him that another winter in the northern climate would prove fatal. Accordingly, Jason travels to Florida for the winter. Payments for transportation to and from the point of the medical care are deductible. This could be a taxi, this could be Uber, this could be mileage, right? So, health insurance premiums paid for medical care insurance are deductible medical expenses as long as you don't use pre-tax money, right? If you use pre-tax money, you're already deducting it. What that means is if you work for an employer and they take out your health insurance from before you get your money in your paycheck, that's pre-tax. For self-employed individuals, 100% of the insurance is an above-the-line deduction on the special line of adjustments for self-employed health insurance. If the medical expenses are reimbursed in the same year, then the reimbursement offsets the deductible amount. If it's reimbursed in a year after, then the reimbursement is income to the extent that you took the medical deduction. If you didn't take the medical deduction, then it's not income. So taxes, so state and local taxes. You get a deduction of up to $10,000 of the aggregate for state and local property tax, so that's real estate tax. State and local income tax. In Massachusetts or Connecticut, that is your income tax, right? I have clients who pay about $9,000 in property tax, right? So therefore, they're not getting too much deduction for their income tax. In states like New Hampshire or Florida, where you do not pay income tax, you can deduct your sales tax in lieu of income tax. So a fee for personal use is not a tax. So an example of that is the fee for trash removal in Springfield. There's a trash fee. That's a fee, not a tax. Excise tax in Massachusetts or Connecticut is based on the value of the car and therefore a deductible tax. There is no deduction for foreign property tax or prepayment of your state and local tax. You can't prepay your state and local tax. Talking about interest. So not all interest is deductible, right? Most is not. Some is. That's how we would say that. So under the Tax Cuts and Jobs Act, a major change was with home equity interest. The deduction is suspended from 2018 through 2025, unless it was used to improve the home or in the acquisition of debt. The definition of a qualified resident interest remains an important one, since this defines acquisition indebtedness from the home equity. So basically, if you cash out your home equity to buy a car, or pay off credit card debt, school debt or something, you can't deduct that. But if you improve the home, you can. So All interest paid or accrued within the taxable year of indebtedness is deductible. Many exceptions apply, making only the following. So they say it's deductible, but only the following is. Qualified residence interest, so that's your mortgage interest. Interest incurred in a trade or business, that's related to business interest. So any interest you're paying to run your business. And interest incurred in the production of income, so that would be interest on rental properties or investment income, etc. Interest includes prepayment penalties, points on mortgages, late payment fees, and mortgage insurance premiums through 2021. So mortgage insurance premiums for the tax years beginning after December 2020 and before 22 allows a deduction for qualified residence interest for mortgage insurance premiums paid in connection with acquisition indebtedness. The amount of the mortgage insurance premiums that can be deducted is reduced by 10% for each $1,000 where AGI exceeds $100,000 for married filing joint, and only $50,000 for married filing separate. As these slides, PMI premiums have not been extended beyond 2021, so currently not in 2024. They are deductible if you have a rental property, because that would be operating the business. Qualified residence interest is principal residence and one vacation home. A vacation home includes a boat or a vehicle with sleeping and eating accommodations. Example would be an RV, right? A vacation home is treated as a qualified residence if the home is not rented during the year or if it does not meet the rental use exception of the 280A. Qualified residence interest must be on debt secured to the principal residence or your second residence, which is considered your vacation home. Acquisition indebtedness is to acquire, construct, or improve the residence. For acquisition indebtedness incurred before 2017, up to $1 million principal is deductible, or $500,000 for married filing separate, the interest on it. During the tax year of 2018 to 2025, they reduced that to $750 principal and $375 for married filing separate. And this is only if your mortgage is more than that, you can't deduct the interest. A home equity loan, equity indebtedness before 2018 and after 2025, the interest is deductible on a maximum of $100,000 principal, $500,000 for married filing separate, and it cannot exceed the fair market value of the home less the acquisition indebtedness. So you can't over leverage the home and deduct the interest. For tax years of 2018 to 2025, no home equity indebtedness may be deducted. This provision sunsets for tax years beginning after December 25. Interest on home equity loan that qualifies as acquisition indebtedness. So sometimes you take a home equity loan to buy a property instead of a mortgage. It's cheaper, and sometimes people do that. That is deductible. Prepaid interest is generally amortized over the life of the loan, with the exception of points paid in the acquisition or improvement of a principal residence. That's deductible in the year paid. Only points on the first $1 million incurred before 2017 is deductible. For the 2018 to 2025, it's $750,000 acquisition indebtedness. The points must be actually paid by the taxpayer. Points absorbed into the mortgage do not qualify for immediate expensing. So investment interest is limited to net investment income. So personal interest does not include investment interest, except Section 163D, however, provides a separate limitation for the deductibility of investment interest because you're making portfolio income on it. The deduction of investment interest cannot exceed the investment income for the year, and the net investment income is the excess of investment income over expenses, not including interest. The taxpayer may elect to include net capital gains attributable to the investment asset and qualified dividends as investment income. If this election is made, a 4952 is required by the taxpayer, is not eligible to apply the lower capital gains rates in the investment income. So usually people aren't doing that because the investment interest isn't worth it. Net investment income includes interest, non-qualified dividends, gains on properties taxed at ordinary rates under depreciation recapture, and capital gains on qualified dividends that can be included if the taxpayer elects to tax them at ordinary rates. I don't know why you would want to do that. Investment interest expense other than interest is those directly connected with the production of the income. In the tax years after 2025, expenses disallowed because of the 2% floor will not reduce net investment income. So, net not deductible for regular tax purposes. If a municipal bond is taxable when AMT applies, the taxpayer may deduct the interest for purchasing the municipal bond when AMT applies. 0.01% or something like that apply to AMT. So I would say that's not happening frequently, currently. Other expenses associated with the purchase of tax-exempt securities are not deductible. Well, if interest is incurred in acquiring a passive activity, the passive activity loss rules apply, and we'll cover this in a later chapter. So back to a summary of what's deductible or not. Qualified residence interest limited to 2 houses or a house in an RV, a house in a boat, etc. is deductible on $1 million or $750 depending on when you purchased the home or when you incurred the debt. The home equity line of credit is a $100,000 limit before 2018 and after 2025. No deduction for home equity interest unless it's in the acquisition indebtedness. The investment interest expense to the extent of investment income. What's not deductible? Your personal credit card interest. Business credit card interest is deductible for the business. Your car interest, your bank loan interest, etc. During the current election, they're talking about potentially making car interest a deductible expense, so that'll be interesting. Interest used to buy tax-free municipal bonds is not deductible, and home equity for tax years 2018 through 2025. The general requirement for income tax charitable contribution deductions. They're made to qualified organizations. They must be subject of the gift is property, not services. So I can't donate my time and deduct that. Even though I would get paid for that time, no deduction. The deductible portion must exceed the value. So I go to a dinner, a charity dinner. The value of the dinner is $45. I pay $100. The difference is deductible. And it must be paid in cash or property before the end of the year. You can't use an accrual method on this. The type of property given away, it depends. So what's the deduction? The type of property given away, the identity of the donee and the contributor, the amount of the property given away, and the place where the charity is organized. So, a qualified organization. Not all tax-exempt and nonprofit organizations are qualified. Social and recreational organizations, such as country clubs, are formed and operated for the benefit of their members and therefore do not meet the general welfare criteria of a qualified organization. The exception is for unrelated business income. However, such organizations may be both tax-exempt and nonprofit. The IRS publishes information about tax-exempt status under 501. The IRS generally will deny or revoke qualified status of an organization if it engages in political activities. So donations to a political activity are excluded, right? Because taxpayers abuse these rules, the IRS has been instrumental in getting the code amended to curtail overvaluing property donated. If the overvaluation results in an understatement of the tax liability of at least $5,000, they can impose a 20% under tax penalty for overstating. No deduction is allowed for contributions of $250 or more unless they obtain written substantiation of this charitable contribution. Additional information is required if you donate property valued over $500 but not over $5,000. A taxpayer must file Section A, Form 8283 for non-cash contributions with a value exceeding $5,000 and $10,000 in non-publicly traded stock. So people do donate stock to charities, and we will talk more about deduction clustering and other strategies around charitable contributions. So it must be exclusively for religious, charitable, scientific, literary, education, or cruelty to animal or children. So the Boys and Girls Club, Elms College, the YMCA, your church donations. There must be no lobbying. It must not benefit a private party, and it must be a domestic charity. Donations of partial interest. The right of the use of property, so rent-free, is not a deduction. Gifts of less than an entire interest are also not deductible unless the undivided portion of the donor's entire interest, a remainder interest is personal, residence, or farm, or a partial interest is transferred, charitable remainder trust, or lead trust. We'll talk about those later. So gifts of service are not deductible. Since the value of a gift was never brought into income, my service, then I can't deduct it. Unreimbursed expenses are deductible. So if I have to pay for something for the charity or I drive at 14 cents a mile, it is deductible. So what are the itemized deduction limitations? So it's 60% of AGI for cash donated to a public charity, and everything that you donate above and beyond that, 60% of AGI rolls forward for 5 years. The non-long-term capital gains property is 50% to a public charity, and long-term capital gains property like a building or stock would be 30%. A private charity foundation or a charitable lead trust would be 30%, 30%, and 20%. When applying the overall 50% limitation of contributions of property, an allowable deduction first comes from 50% gifts, then 30% gifts, and finally 20% gifts. If cash contributions are also made, the overall 50% limit is first reduced by cash contributions. Deductions disallowed for AGI will be carried over for 5 years. First in, first out order. Taxpayer, so an example, taxpayer with $100,000 AGI contributed $40,000 cash and long-term stocks with a fair market value of $35,000 and a basis of $8,000 to the university. So AGI is $100,000. So 60% of that is our cash limit. So $60,000 is our cash limit. Our 30% limit on long-term capital gains is $30,000. Our overall limit for property is $50,000. So the taxpayer's amount of the deduction, they get to take the $40,000 cash and $10,000 in the stock for a total of $50,000, and then they're going to carry forward the difference, the $25,000 in the stock, so $35,000 minus 10, as a 30% asset into the future. Deductible for 5 years, right? Fully deductible gifts of cash are subject to AGI limits. The excess contributions are carried forward 5 years. Corporate donations, so these are C Corps, are deductible with a limit of 10% of taxable income. Pass-through entities put the charitable contribution on the personal tax return, Schedule A. Contributions to institution of higher ed in return for the right to purchase tickets are not permitted with any deduction. So long-term capital gain property, intangible personal property, and real property are subject to a 30% limitation. They can qualify for the 50% by reducing the value of the gift by 100% of the gain. I'm not sure why you'd want to do that, but there might be a reason. Tangible personal property used by the donee for tax exempt. Enter the entire fair market value at the date of the gift is deductible, subject to a 30% AGI limit. And then if it's not used by, so tangible property would be like the car or a minivan or something. If it is not used by the donee in a tax-exempt purpose, so I donate the car but they don't need the car, the value of the fair market value of the gift must be reduced by any potential gain and is subject to a 50% limitation. What about ordinary income property? This is short-term capital gains assets, works of arts, letters, musical compositions, if given by the person who created them, and a business person's stock in trade and inventory. The deduction is limited to the cost basis that the person has. Works of arts, letters, and musical compositions contributed by someone other than the person who created it or prepared it, they are capital gains property. So this is a chart that would tell you, so if you're not sure when answering multiple choice questions, I would refer to this chart. Like I said, the C corporation can take a deduction of up to 10%. An S corporation or a partnership would pass through charitable gifts on their Form K-1 to owners that would be deductible on their personal tax return. When a contribution exceeds the taxable income limitation, the excess is carried forward for 5 years. So talking about casualty losses and the deduction for that, only a few deductions are allowed for personal losses. For 2018 to 2025, the loss is only if attributed to a declared federal disaster. So, for example, the most recent hurricanes, those would be declared disasters. This applies to extreme cases where taxpayers have suffered a large loss, a fire, a storm, a shipwreck, a theft, or other sudden unexpected event causing a loss. So the hurricane, right? So we need to know, was it a business loss? Then that would be above the line. Was it personal, your personal residence? What if you didn't have it insured and Hurricane Helene or one of the other ones hit, right? Then it would be a Schedule A itemized deduction loss. The amount of the loss and its deductibility depends on whether the loss is from business or personal, whether the loss is partial or complete. The Tax Cuts and Jobs Act did not change the rule for business casualty. Deductions for personal losses is the lower of the decline in the value of the asset less insurance proceeds received, or the taxpayer's adjusted basis in the property less insurance proceeds received. You further have to limit personal losses. You deduct $100. Why? I have no idea. It's just random $100. And then only casualty losses exceeding 10% of AGI are deductible. If the casualty loss gains exceed losses, the gains offset the losses suffered in the same year. Excess gains are treated as the sale of a capital asset. It could be short-term or long-term depending on the holding period of that asset. A deferral of the gain provision is allowed and will be discussed in non-taxable exchange chapter, so a different chapter. So losses are, gains are recognized, and then losses are deductible in the after insurance recovery, 100% floor, and then 10% of AGI. Dwight owns a home in New Orleans that was severely damaged. He purchased the home for $200,000 with a fair market value prior to the hurricane was $400,000. His homeowner's insurance lapsed the month before the hurricane hit, and he did not have any other insurance. After the hurricane, the property had a fair market value of $90,000. This was a federally declared disaster area. Dwight's casualty loss is valued at $200,000, which is his adjusted basis less zero in insurance proceeds. His economic loss is $400,000 fair market value minus the $90,000. So he technically had an economic loss because he could have sold that beforehand of $310,000. Since Dwight never paid taxes on this built-in gain in his house, he cannot take the deduction for the economic loss. Instead, he will take the deduction for the $200,000 adjusted basis loss and then apply the rules. If Dwight's property was fully insured, he would have received $310,000 less his deduction, so his deductible. Continuing with the facts, assume Dwight's AGI is $100,000. Dwight's casualty loss is $200,000. It must be first reduced by the $100 and then reduced by 10% of AGI. So his portion of the casualty loss is $200,000 minus $100 minus $10,000, which is the AGI. So $189,900. Had the loss been caused by had the loss not been caused by a presidentially declared disaster area, it would not have been deductible at all, even though he lost $189,000 or more, right? Above the line deduction depends on the cause of the event. A complete casualty, if fair market value is zero, then the loss equals the adjusted basis of the property minus proceeds. A partial loss, the loss is the lesser of the declined in value or the adjusted basis less proceeds. So here's an example. No insurance proceeds received. Item A, the adjusted basis is $600, fair market value is $800, fair market value after the loss was $5,000. So they had technically adjusted basis of $6,000. They can't take the full $6,000 because the decline in fair market value is only $3,000. Item B, adjusted basis is the same, but fair market value went from $8,000 to $1,000. So they take the $6,000, not $7,000. You can only take the the lower of the adjusted basis or fair market value loss. And then in example C, $6,000, the fair market value was $4,000. So because fair market value had declined, you still get the $6,000. The basis is always, this is always limited to basis in a business casualty loss. So the miscellaneous itemized deductions before and after 2025, before 2018 and after 2025, fully deductible currently are gambling losses to the extent of gains, but these are on your Schedule A, so are they fully deductible? We'll walk through an example of that. The credit for estate tax on IRD assets, the loss on annuity contracts, and the repayment of income. What is not deductible, subject to the 2% floor during these time periods of the Tax Cuts and Jobs Act, unreimbursed employee expenses, hobby expenses to the extent of hobby income, investment expenses, tax advice and preparation, loss on terminated IRAs, educational expenses to maintain and improve taxpayer competency, and home office. So one of the whole points of this class is to talk about strategy for tax planning. So a tax planning strategy in which itemized deductions are clustered. You want to write this down. You're going to have to come up with strategies, right? Or bunched together in 1 year, making a higher standard deduction. So a taxpayer can take control of certain property taxes, payment of mortgage interest, medical expenses, and charitable donations. The most likely one is the charitable donations. So let's just say you always made a $5,000 donation to a charity. Instead of making that every year, you put $15,000 and you deduct it on 1 year, and then that counts as a donation for you. You just don't give them the donation the next 2 years. You can also form a charitable trust, which we'll talk about later. Qualified business income deduction. I'm not going to ask questions on the midterm on this in general, except for, do you know what it's for? I'm not going to make you make calculations. The below the line deduction is available regardless of whether you select standard or itemized deduction, and it's to create a parity in the tax treatment of pass-through entities versus a C Corp. Pass-through entities are sole proprietors, partnerships, LLCs, and S corporations. QBI is the net amount of qualified items of income from eligible pass-through entities. It does not include capital gains and losses, dividends, interest, not allocable to a trade or business, commodities, reasonable compensation for S Corp owners, and guaranteed payments to partners for services rendered. In general, the QBI deduction is equal to the lesser of 20% of qualified business income or 20% of your adjusted taxable income. Adjusted taxable income is from all sources after taking above the line deductions, excluding the deduction related for self-employment, health insurance, and self-employed retirement plans, and taking either standard and itemized deductions reduced by capital gains. This includes your spouse's income if you're a married filing joint. So, Jana's share of qualified income from a partnership was $90,000. Her total adjusted taxable income from all sources is $70,000. The deduction is the lesser of the $90,000 or the $70,000. Therefore, she gets the lower. As you can see, there's a theme. It's always the lower of, right? Kylan's share of qualified business income from a partnership is $90,000. And her total adjusted taxable income from all sources is $110,000. Well, then you take the lower, 20% of $90,000 or $18,000. So the QBI is phased out based on taxable income from all sources, including your spouse's source. So it's excludable if you're married filing joint and your threshold is $383,900 to $483,000. After that, you get no QBI. All others that aren't married filing joint are $191,950 to $241,950. The QBI deduction is limited for trades and businesses. So this phase out is for people in these fields. So accountants, doctors, dentists, lawyers, actuaries, consultants, performing arts, video game streamers, financial services, athletics, investing, investment management, so anyone in financial services, trading or dealing securities, any trade or business where the principal asset of the business is your reputation or skill, content streaming, any of those things. It's limited to those AGIs. Now, if I'm a plumber or if I'm in real estate, it's not limited, by the way. And this is a chart to walk you through the very complicated tiers of QBI. And now you can work on the online class questions for Chapter 7.